Hi, everyone. Thanks for joining us today. I'm Ervin, the CEO and founder of Blockforce Capital. And with me, I have Brett Munster, who's managing partner and lead portfolio manager of the fund. Today, what we wanted to do was spend about 20, 30 minutes to really discuss why the opportunity in crypto is what it is today and why it is so timely right now. Then we'll touch a little bit on why Blockforce, what we do, how we think about the markets as a whole, and then what kind of returns are we trying to deliver ultimately to the end investor. So with that, I'll turn it over to my partner, Brett Munster.
Great, thanks, Eric, and yeah, happy to be here. So really quick, we wanted to dive into just a really quick, brief overview, given that different people have different levels of experience with the crypto industry and crypto markets. We're going to start with Bitcoin, and then we'll dive in a little bit more to some of the other networks. But we want to start with Bitcoin, the network, and talk about what is really the innovation here. So I want to draw a parallel to the internet. The internet consolidated communication across one universal protocol. Before the internet, communication methods and media lived in independent, closed, inefficient, expensive local networks. So for the news, it was constrained to local geographies. If you lived in LA, you got the LA Times, but then not the New York Post, and you only got it once a day and not in real time. You had no control over your TV programming. There were limited choices of what shows or movies you could watch and when you could watch them. You couldn't listen to music on your TV, and you couldn't watch TV on your radio. Messages could take several days to send via the postal service. And so you could just see how prior to the internet, communication media was largely inefficient. But when the internet came along, that all changed. And so for the first time, we had this universal communication protocol, which really dematerialized traditional communication methods into a single global communication network. You could now stream TV, music, movies, all from the same device. We can pick what we want to consume and when we want to consume it. Internet eliminated geographic barriers, time constraints, region-specific limitations. Communication became borderless, instant, accessible to anyone who opted into this internet network. It's faster, it's cheaper. It allowed people, communities, companies to connect to anyone in the world. And that was great for media and communication. But there was never a financial counterpart to this internet revolution. Our financial infrastructure never made the same leap. There's Western Union and TransferWise for remittances. There's Visa and MasterCard for processing, Venmo and Cash App if you're in the US, and that doesn't work overseas, so you've got to use Revolut if you're in the UK. Just try sending a Venmo payment to a Zelle account or using Visa to send money to your friend's bank account. You simply can't do it. There are some poorly stitched together financial infrastructure that come with different levels of fixed cost and efficiencies, counterparty risks, settlement delays, fees, all these middlemen. International bank wires can take anywhere to 1 to 5 days to settle. Payments go through intermediaries known as these corresponding banks. There isn't direct communication. And that's all assuming you even have a bank account in the first place. If I lived in a developed nation like the US, I probably have access to these financial services. But if I live in an emerging country, I might not have access to any of this, just basic financial services, including bank accounts. So what the internet did for communication, Bitcoin is really doing for money. So for the first time, we have this first open, global, singular monetary protocol that anyone and everyone can access. This ability to send and receive value across borders permissionlessly really has nothing to do with Bitcoin's price at all. You can literally take money out of your bank account, convert it to Bitcoin, send that money across anywhere in the world to anyone at any time. Under a second, that person can then convert immediately into whatever currency they then choose. And what you've now done is you've sent value over the Bitcoin protocol. It doesn't matter if you sent 1 Bitcoin or 100 Bitcoin or 0.0001 Bitcoin. So the price didn't matter. You can now move money free and effortlessly. So, we really think, remittance companies and like Western Union are basically Blockbuster at this point. It's just a matter of time. They can't compete, just like newspapers couldn't compete with the internet. Simply put, Bitcoin network is the greatest settlement network ever created. And like I said at the beginning, what the internet did for communication, the Bitcoin network did for money. And we see that in the actual data and the usage. So Bitcoin is a natively digital bearer instrument. It can achieve instant, free, global cash finality anywhere. This is not credit. This is not taking 1 to 3 days to settle. This settles instantly. It's the same as me handing you cash. It's final settlement. It's also important that Bitcoin is this settlement layer, much more akin to Swift or ACH or Fedwire, that batch these transactions and settle trillions of dollars every day. Never before have we had a settlement network that can achieve final clearance with no intermediaries or credit. Never before have we had a monetary network that can achieve final settlement this fast. We never had a settlement network that had a monetary network that was this cheap. Never has it been this open and accessible to anyone in the world. I think the confusion a lot of people make is, well, what about Visa and MasterCard? Well, Visa and MasterCard were built on top of these bank rails. They're a payment network built on top of settlement networks. Well, just like Bitcoin is a settlement layer, there is now layer 2 networks that are payment networks built on top of Bitcoin, the most prominent of which is Lightning. So Lightning Network, without getting too much detail, is faster, cheaper, more secure than Visa and MasterCard. And so now what you have is arguably the fastest, cheapest, most secure payment network that can do instant global final settlement anywhere to anyone in the world as long as they have a smartphone and internet connection. And so for the first time ever, we don't need that traditional infrastructure. We don't need all the middlemen. We can directly move peer-to-peer. Eric, anything else you'd like to add?
This point about how, in the early days, the internet allowed us to send messages back and forth. Email is probably, the first big killer app, I think, that hit the internet. That is just a protocol. SMTP is just a different protocol, but value over the internet was not really invented until the Bitcoin network. And really that became the kind of aha moment for a lot of people, where like, oh, okay, now we can actually send something and know that somebody else doesn't have an exact copy of it. It's unique and completely censorship resistant, which is great.
And so that's the underlying Bitcoin network. So I want to talk about Bitcoin, the asset, the actual token, and what is unique about this asset and what is the innovation behind this. Kind of want to bring this back to money. So throughout history, economies started out as barter systems. That obviously has limitations. Barter only works when two parties have what the other party wants. And so if you don't have what each other wants, that's called the coincidence of wants problem. So money was invented to solve this coincidence of wants. In order to do that, money needs to do two things. It needs to store value, or our work, things we get credited for, over time and across distances. So if I go to work, I want to be compensated for my time, for the value I create. So I don't want to be compensated in groceries because maybe I don't want those groceries. I want to be able to choose at a later time, and maybe not from that grocery store, but a different grocery store, what I want to exchange that for. And so we need to be able to move money over time and across space, and we need to be able to store that value. So let's talk about these two dimensions really quickly. I'm going to start with gold, because gold's kind of the oldest form of money. Over time, we've had many things, but eventually societies across the globe independently converge on gold forest properties. It's relatively scarce compared to many other materials. It's durable, it's fungible, it's divisible, it's verifiable. But as technology improved, specifically communication technology improved, that portability became a barrier for using gold. Gold worked great when we moved around physically in horse and buggy, because you could move gold right along with you. But as soon as we invented the telegraph, and then the telephone, and then the internet, the speed of transaction increased to basically the speed of light. And so gold as a bearer instrument could never move as fast. And so over time, we continue to abstract away from gold in order to keep up with our economy, with the speed of transactions that were taking place. And so this mismatch or gap in speed is a fundamental reason for, I think, the greater and greater levels of financialization we've seen in this world. And gold still holds its value over time. It still does a great job of that, but it's impractical to use on an everyday basis, because, it can't keep up with, the internet of transactions. Fiat, on the other hand, is basically just the exact opposite. To solve kind of gold's portability challenges, we increasingly moved towards fiat currencies over time. even when economies, inflation is modest and controlled, it still erodes purchasing power significantly over a long period of time. The US dollar, which is the best performing fiat currency over the last century, has lost 96% of its value over the last 100 years. So essentially over someone's lifetime, if you had $100 at the beginning, that $100 by the time that person dies is likely to be worth single-digit dollars. And keep in mind, that's the best, most stable performing currency out of over 160 currencies worldwide. By no means are we calling for the death of dollar. In no way are we saying dollar isn't incredibly important. What we're simply highlighting here is that fiat does not hold value over time. It's great for short-term purchases. It's great at moving across distances quickly, but over long periods of time, it doesn't hold its value. And so this is important. When we live in the United States, we've got access to the dollar, but 87% of the world's population is actually born into considerably less trustworthy financial systems. So think Argentina, Venezuela, Nigeria, Cuba, Turkey, Lebanon. I can go on and on. Countries are experiencing hyperinflation. And so in all of these countries, in all these geographies, you see a marketed increase and uptick in Bitcoin usage and adoption in all of these regions. And so really Bitcoin is the best of both. You get the attributes of gold, but in a digital asset that can move at the speed of light. Bitcoin's scarce, is only 21 million. It's durable, it's easy to verify. It has all the characteristics and even better than gold. So it holds its value over time, but it's also digital, which means we can move it across the world seamlessly, effortlessly. I know in the US, we don't think about using Bitcoin as a medium of exchange, but there are places throughout the world where that is absolutely not true, where people aren't using Bitcoin as an investment or a speculative asset. They are using it for everyday life and purchases. Eric, you recently went to El Salvador. Do you want to comment?
Yeah, I mean, I was really shocked. I've heard, obviously I'm in the industry, so I've heard about the Bitcoinization of El Salvador, but really, truly, everywhere from McDonald's to the coconut vendor on the side of the beach was accepting Bitcoin, which is wild.
We expect that adoption to continue over time. Crypto industry is much more than just Bitcoin. Digital gold is just one application of many. And we love Bitcoin. We think it's great, but it is only a portion of the overall crypto market. And we're seeing more and more real world use cases of crypto tokens and blockchain architecture and token-based incentives that are really beginning to disrupt many different parts of the financial system. Those include stable coins, smart contracts where we can build decentralized applications on top of. You're seeing a lot of DeFi usage, especially in trading and borrowing, lending. You're seeing tokenization of real world assets. There is a really interesting mix between the AI development, both on the computing power and model development, AI models, and crypto. And you're also seeing these token economics starting to disrupt even physical infrastructure like telecom industries. And so there's a lot of these really interesting pockets where, much like the internet disrupted, TV and movies and radio and all sorts of different industries, we think crypto is not just digital gold. It's not just Bitcoin. It's going to disrupt a number of different industries over time.
For the audience members who don't really understand this whole thing, so Bitcoin is one specific use case, and there's other blockchain-enabled tokens and networks, if you will, that are completely different, but they're all kind of stemming from this value over the internet protocol.
And so we think crypto still has this immense growth potential. So even just digital gold, Bitcoin's about a $2 trillion asset today, a little less than 2 trillion. And so even if it got to on parity with gold, Bitcoin would be $900,000 per Bitcoin. Still a huge value appreciation. But gold is analog and Bitcoin's digital. And anytime we've ever moved from analog to digital, the market grows. Just think Uber, Airbnb, Google, Amazon. Anytime we move from analog to digital, the market grows simply because the number of market participants grows, access increases. So we think Bitcoin can actually grow to be much bigger than gold. But that's not just the only thing crypto's touching, but we're seeing decentralized exchanges and tokenization that makes trading equities faster, cheaper. Not everyone in the world can go trade Apple stock today, but anyone in the world can access a decentralized exchange. And as we bring those assets onto those token-based networks, you're going to increase the market to be able to trade Amazon stock and all sorts of different assets that many people just simply don't have access to. You also have the global bond market, and that's a store of value. And again, we think Bitcoin will eat into that, but it's not just that. We're seeing the tokenization of the bond market being put onto the blockchain. You've got BlackRock with their Builder offering growing immensely. Franklin Templeton is doing this. You're seeing a lot of those bond markets start to move on chain. Real estate's the same way. The global real estate market's huge. And again, it's not just that, owning a home is maybe potentially a good store of value, but houses have taxes and upkeep costs and they're not liquid. So Bitcoin's probably going to eat into instead of having a third, fourth, fifth home, Bitcoin might eat into that. But again, it's not just Bitcoin. You've got tokenization of real estate as well. So just imagine if I had a mortgage and I wanted to pay it off today, I could tokenize my house, raise the money, pay off my mortgage, and now I no longer have that monthly payment. And the investors that bought into that could get the upside when I sell the house in the future. That's just one potential use case. Those sort of things are coming. And so we think crypto and blockchain is going to eat into all these enormous markets. Today, crypto is just a $3 trillion market. And yes, that's big, but the growth potential here is still so enormous over the next decade plus.
Yeah, I think of it as it's really just a technology. It's an efficiency tool because if you think about the average financial ecosystem, stock brokerage house in Wall Street or otherwise, probably a third of their overall expense and cost structure is back office and middle office, which is a bunch of spreadsheets going back and forth over email versus, say, a blockchain, which is just a shared database, a shared ledger where anyone can access around the world. And you can get rid of a lot of that cost. And by getting rid of that cost, same thing with real estate, like title insurance, still boggles my mind that in this day and age, we have to hire somebody to look up the title ownership. So it's just, it's like that layer of overhead and kind of morass of the financial system that can be taken out and replaced with a lot of blockchain initiatives.
We're going to go into kind of why now, why 2025, what is so interesting? And we're going to start with kind of the regulatory change. Now, quick disclaimer, none of this is an endorsement for or against any politician or political party. We truly believe that crypto is and should be a nonpartisan issue, just like any other technology. But this is us just simply laying out, I think, the change in regulatory environment and what we're seeing happening on the ground. So with that, over the last couple of years, the US regulatory landscape has really been defined by this aggressive crackdown on the crypto industry. We've had federal agencies, most notably the SEC, issue lawsuits and weld attacks against a lot of US-based crypto firms. The SEC introduced SAB 121, which effectively barred banks from custody and getting into this asset class. The FDIC forcibly shut down the two leading crypto banks and basically orchestrated what has now become known as Choke Point 2.0, which effectively made banking for the entire industry very difficult. You've had politicians come out with what are now debunked narratives of crypto financing terrorism, simply not true, pledging to build an anti-crypto army. We've had bipartisan legislation get blocked by certain US senators over the last couple of years and never be allowed to come to a vote. We had a pretty hostile regulatory environment over the last 2 years, and yet, despite all that headwind, Bitcoin's resilience, the crypto market's resilience showed through. Adoption among Americans has now, over those 2 years, grown significantly and is at record level highs. Prices climbed from $17,000 to a year ago to just over $100,000 at its peak thus far. The crypto industry thrived in what could be described as an incredibly hostile regulatory environment. And now everything has really changed. So for the first time, when Trump was inaugurated, we now have the first ever president that ran on a pro-crypto, pro-Bitcoin platform. He said in a number of interviews that he has an informal target of 150,000. He's literally trying to get Bitcoin up in price. I think this figure is speculative, but it underscores really that Trump is actively viewing, much like the stock market, the price of Bitcoin, price of the crypto asset industry as a measure of success for his presidency. He obviously signed an executive order, and his talk that was very pro-crypto and has talked about repeatedly removing capital gains on certain crypto assets. We'll see if that comes to fruition, but that would be a big boon. He owns multiple crypto businesses in DeFi, NFT, meme coins, and really honestly, a significant portion of his net worth is now in crypto. As we've seen in recent weeks, he's advocated for a strategic digital asset reserve, but it's not just Trump. JD Vance, the vice president, has said in interviews that 50%, half of his net worth is in crypto. He is a big advocate. Scott Bessent, the now Secretary of Treasury, has been a very pro-Bitcoin outspoken. Howard Lutnick might be the most bullish crypto advocate of them all. He came from Counter Fitzgerald, which does a lot of the backing for Tether, and has personally said that he owns hundreds of millions of dollars worth of Bitcoin and crypto assets. He's also notably the one running the new sovereign wealth fund. So I would be surprised at all if we see different crypto assets in a sovereign wealth fund if and when that gets created. We have a new AI crypto czar, a new position that is built within the White House. And that's headed up by David Sachs, who's a longtime VC, specifically is invested in Bitcoin, Sol, number of different crypto projects. So you've got this throughout the administration, but it's not just the administration. We had this huge, not a blue wave, not a red wave, but what I'd like to call an orange wave happen in Congress, where now that over 60% of congressmen, both in the House and Senate, have now been publicly supportive of crypto assets. We have French Hill, who has now who's been one of the most vocal supporters. He is now leading the House Financial Service Committee. Tim Scott, who again, been extremely positively outspoken about the crypto industry, is now heading the Senate Banking Committee. These are two very key committees that are going to help push pro-crypto legislation. We've got likely a stablecoin bill coming to market. We likely have a market structure bill. These are things the industry has been clamoring for years. I think we've now got the environment where we're actually going to see some of these measures passed. And again, this extends beyond just the administration and Congress. First of all, the SEC, has seen a dramatic overhaul. So Gary Gensler, maybe the industry's most prominent antagonist, he stepped down, making way for Paul Atkins, who's been, again, a vocal advocate for crypto assets. But it wasn't just him. You've had two other SEC members who have now stepped down or haven't been reconfirmed. And the two pro-crypto SEC members from the last several years are still with us. So now you have three crypto members. Hester Pierce is, her nickname is Crypto Mom. She is heading up the new crypto task force that's really working with the agency. And even in their first few weeks, they've already done a number of amazing measures. They've repealed SAB 121. And as a result, we've already seen BNY Mellon, State Street, Citi. These are three of the largest custodian banks in the world, have all announced crypto custody services. The moment the SEC gave the green light, they jumped in. They repealed the broker-dealer rule, which would have made DeFi, impossible to comply with regulations. Most importantly, drop lawsuits against Coinbase, Binance, Gemini, Robinhood, Kraken, OpenSea, Consensus, Uniswap, others. There's already been this complete 180 shift in just the approach from the SEC since Gensler has stepped down. And it's not just the SEC. We've also seen, similar changes in the CFTC, FDIC, OCC too. At the CFTC, Brian Quintenz was formerly from Andreessen Horowitz, who was the crypto policy expert there. He is now the CFTC commissioner. Probably could not have asked for a better person from our industry to head that up. He's wonderful. And Jonathan Gould is not just an OCC veteran, but he was a chief legal officer at a blockchain development firm called Bitfury, and literally used to work at Bitcoin mining companies and has invested in crypto projects. So you've got folks with deep expertise in these very powerful positions. And so for the first time ever, we now have the US government as an ally. So for crypto's first 12 years of its existence, it was largely ignored. The government was indifferent. And in the last couple of years, we've had a US government that was hostile. We've never seen the crypto industry operate in an environment where the US government is actively supportive. And again, remember, despite all this, despite crypto grew from $0 to $3 trillion without a supportive government. Now that we do, It's so exciting to think of what could possibly happen when you do have a supportive government. And this doesn't mean it's the Wild West. It means we get clear regulation, clear rules. It will allow an environment that, entrepreneurs can actually build interesting companies. Hopefully it eliminates a lot of, problems or fraud that has plagued the industry. This is the, first time where all that is really coalescing and coming together.
Yeah, I think it actually makes a lot of sense just from a timing perspective. Governments don't really get involved in industry and shouldn't get involved in industry until an industry becomes so important to the future of a society. And when you think about like big game changing platform, new technology innovations, internet, the smartphone, and so on, as an American, if you're a politician, you kind of want that technology to grow and to be like fostered inside of your border, because that's where all the innovation is going to happen. And there could be a massive amount of new jobs and stimulus and other things that can happen there. So it really is like a $3 trillion industry is not trivial. It's something to pay attention to.
We're going to move on now to another reason. And I want to talk about supply and demand. And what we're going to start with on the supply side. It's worth noting that for the first 11 years of Bitcoin's existence, the number of available coins steadily would increase. This makes sense as new coins that were released would come on the market early in Bitcoin's life cycle. However, that trend saw a very stark reversal starting in March of 2020. It does happen to coincide with the COVID relief stimulus. The data does show that starting in March 2020, more and more people began taking the Bitcoin off exchanges and storing them offline. This indicates much more long-term oriented investors. They're not looking to just trade this. They're looking to hold this for a long period of time. In fact, we see that almost 2/3 of the Bitcoin in existence today has not moved in over a year. Almost half of the Bitcoin in existence hasn't moved in 3 years, and almost a third hasn't moved in over 5 years. I just think about everything that's happened over the last 5 years, and yet there's this group that are just holding through it all because they believe in this long term. This is very different in this current bull market than any previous other bull market. During the large run-ups of 2010, 13, 17, 21, that supply on exchanges was increasing as price was running. This is the first time we've ever actually been in a bull market where supply is decreasing. It's not that it's disappearing. It's just people are taking it off exchanges. It's not available to be traded.
It's also kind of a testament to, as a quant and as a quant asset manager, we pay attention to a lot of data. It's pretty cool to be able to see this kind of data, to know who owns and how many people, not necessarily who the human is that owns, but really like how many people own it, what their average cost basis is. Are they sending it to the exchange where they're likely to trade it, or are they taking
What's their
it off
history
the
been like?
Yeah.
Do they historically buy and sell a lot, or do they buy and hold for long periods of time?
And it's all just there in the public domain. Like it's a very rich data set.
So that's the supply side. So let's go to demand, because this is the other half of the equation. It's worth pointing out that crypto industry is actually growing faster than the internet did. So if you compared crypto adoption by number of users starting in 1990 and that growth over a 10-year period, if you compared that to crypto number of users in 2015 over the last decade, at the start of 1990, the internet had nearly 3 times as many users as there were crypto users in 2015. Fast forward a decade, now that number has completely flipped, and that there's almost double the amount of crypto users worldwide as there were internet users over that same period of decade by 1999. And so what we're seeing is this growth is faster than the internet. Growth and adoption is outpacing any other technology platform that's ever been in existence previously. We've also seen this, drive come from individuals, sometimes referred to as retail, but like individual users. So it's worth noting that both Binance and Coinbase have more users than JP Morgan or Wells or Bank of America or Fidelity or Vanguard. There are a large number of people, hundreds of millions throughout the world, that are buying and selling and using crypto assets. Robinhood's recent huge run-up in growth is largely attributable to its crypto trading revenue, which is up 733% over the last year. It is undeniable that you're seeing a ton of users and individuals flock to this asset class. But it's not just individuals, it's also institutionals. So the launch of the Bitcoin ETF just absolutely blew every record out of the water and just opened the floodgates for institutional adoption. And we know this was a large part driven by institutions because, one, you don't get to over $36 billion of net new capital from just individuals. You have to have large pools of capital to get to that level. But what's really interesting is that we've actually seen the latest 13 filings, and that shows that there's over 1,600 institutions that now own Bitcoin ETF, up from 17% in Q3 to 28% of the total dollar value by the end of the year. And so we think this trend is going to continue to happen, and we think institutions are going to make up a larger and larger portion of these ETFs, and it could exceed 40% by the end of the year. The other thing worth noting is that was a huge year one, but almost always does year two of an ETF outpace year one, which means if the Bitcoin ETF follows any historical precedent, it wouldn't be shocking at all to see over $50 billion of net new inflow of capital into the ETFs in this year. We've got like legendary investors like Paul Tudor Jones, who now have Bitcoin as its largest position in his portfolio. Stanley Druckenmiller, Ray Dalio, Ken Griffin, Larry Fink, all these big traditional asset managers are all allocating. You've got pension funds, you've got university endowments, you have now sovereign wealth funds that are all buying Bitcoin. So you're seeing this large growth in institutional adoption.
It's also important to note too that the institutions they take a much longer view on things. So they're not typically trading in and out of these assets like the individual investors might be on Robinhood or others. Whereas like the Harvard Endowment, if they take a position in a Bitcoin ETF or a gold ETF, it's usually a very, very long-term position because they're thinking again about the endowment. So usually that would imply that these assets aren't going to be churned a lot. They're here and they're here to stay, which is less supply on the market.
Yeah, great point. Another phenomenon we're seeing is the rise of corporates. And so corporate adoption of buying Bitcoin and holding it on their balance sheet is accelerating. Obviously, MicroStrategy or now Strategy has been the leader in this regard, but over the last year, we've had 38 public companies grow to 123 public companies now hold Bitcoin on their public treasury. And so what's amazing to see about this is MicroStrategy has outperformed NVIDIA, Apple, the Magnificent. It's outperformed everything since it first adopted a Bitcoin treasury strategy. There's also a copycat on the Japanese markets called Metaplanet, which was just this fledgling hotel company who has reinvented itself as a Bitcoin treasury firm, very similar to MicroStrategy. That was the best performing stock global worldwide last year. We're going to see more and more corporates buy Bitcoin, put it on the balance sheet, and hold it. I think this is going to become, not just commonplace. I think it's going to be considered best practice to hold some small percentage of a corporate treasury in Bitcoin. And I think we see this trend continue throughout the year. What's really interesting is it's not just corporates either. We're also seeing governments. And we're going to start with the state adoption. So today, there are 24 states in the United States that have introduced a strategic Bitcoin reserve bill. This is buying and holding Bitcoin on the state balance sheet. Now, Utah and Arizona are the furthest along. In fact, they are both in the final stages of the approval process. So they're likely to be the first to actually adopt this. Is something we're likely going to see this year. And, I think over the next couple of years, that could drive, $20-30 billion worth of inflow of net new buying pressure into Bitcoin. To put this in perspective, if Texas was its own economy worldwide, it would be a top 10 global economy. So these are not small. I know it's not federal level, but Texas buying Bitcoin can do this on a large scale, larger than many other countries could. And then finally, it's not just states, it's also at the federal level, nation states. So I want to be really clear about this. We are already in the early stages of a global arms race. This isn't theoretical. This is actually happening. There are a lot of countries out there that we know publicly that are buying and holding Bitcoin. There are a lot of very credible rumors about a number of countries that have not yet made it public that they're doing the same. So this list is probably going to grow throughout the year. We've heard from Congress, especially from Senator Loomis, about a strategic Bitcoin reserve. We've had the president tweeting about wanting to do this. We've had Abu Dhabi recently just announced that they bought, almost $500 million worth of Bitcoin and holding it. Russia has publicly announced that they're exploring the creation of a strategic Bitcoin reserve. Brazil has introduced a natural Bitcoin reserve bill. Japan has publicly talked about this. Poland has publicly talked about doing this. We've seen countries really start to adopt this strategy, and it's really kind of game theory. As one starts to do it, you almost force every other country to do it just because you don't want to be left behind. So I think we're going to see this arms race really pick up over the next couple of years. Just think about that really quick. You've got individuals buying, you've got institutions buying, you've got corporates buying, you've got states buying, you've got federal governments and nation states buying. Again, all while supply is dwindling. I don't know what's going to happen to Bitcoin and crypto over the short term. I don't know what price is going to do tomorrow, but over the long term, if supply is going down and demand is going up, over the long term, it's very likely price is going to appreciate. And again, that's why we take this long-term view at our fund. And then lastly, we want to talk about global liquidity. Because Bitcoin has this very transformative monetary policy that's very different than fiat. It has a supply cap of 21 million versus an unlimited amount of fiat. It has a issuance rate that decreases over time versus we're seeing an accelerated issuance rate of dollars and global M2. It's a very predictable, unchangeable monetary policy that's immune from political whims compared to the dollar. The amount that is printed and the interest rates is basically made by a small group of individuals that changes and varies from month to month. So it's got the exact opposite policy. So it's no surprise that when global liquidity rises, Bitcoin's price responds. And we've seen this in a lot of different research, this correlation. And so why do we bring this up? Well, we really think that this year sets the stage for global liquidity to rise. And we think for 4 reasons. One, the dollar has been strengthening. While that typically signals a robust economy, it also means that a lot of the dollar-denominated debt around the world becomes more expensive to service for countries and corporations. So there is growing pressure globally for a weaker dollar to ease a lot of these debt burdens. Domestically, interestingly enough, there is an incentive for a weaker dollar too from the Trump administration. If he really wants to fulfill a lot of his campaign promises, specifically reshoring U.S. industries, making U.S. exports more competitive, he needs a weaker dollar. There is no way around it. That absolutely has to happen. He could also stimulate the stock market by injecting more liquidity. These are things that Trump is very likely to want to see happen. We're also starting to see a liquidity squeeze in the reverse repo market. So as institutions exhaust this kind of short-term funding source, the pressure will mount on the Federal Reserve to step in. We've seen this in previous years where the reverse repo market gets under stress and the Fed steps in and provides a lot of liquidity. And then finally, we think we're entering in this era of fiscal dominance that because of inflationary pressures, it's hard for the Federal Reserve to bring down interest rates. Who knows if they will or won't, but to support economic growth, then the only real viable option or the best viable option is to expand the Fed's balance sheet. Whether they call it quantitative easing or not, or they use some other name, it essentially is going to result in increased liquidity. And so, this isn't just speculation. We've seen this in the data. Dollar liquidity is on the rise. Global liquidity is on the rise. We think that is going to eventually make its way into not just the stock market, but also the crypto market. So we think long-term, this is a really bullish trend for the crypto industry. So really quick, Eric, I'll kick this over to you, but so why Blockforce? Why us? Why versus anything else? And I'll let you kind of talk about kind of maybe the 3 big pillars.
Yeah, I think the biggest point there is that there is a huge opportunity right now presenting itself, but with opportunity comes risk and comes a lot of volatility. As markets try to figure things out, Bitcoin has been one of the better performing, or I should say blockchain and crypto in general has been the best performing asset class over the last decade, but it's not without a lot of stomach acid. Our approach was really, how do we harness and capture some of that upside, most of that upside, in our opinion, without all of the stomach acid? So how can we be in the market and create a vehicle that gives people the opportunity to capture that upside of the market, but again, without getting scared out of the market due to volatility and shocks and the like. And so we created Blockforce Capital. It is a quantitative crypto asset hedge fund. We really have two different pieces of the fund. We have one, which is the long-term value appreciation part of the portfolio. And then the second, which is the shorter term systematic algorithmic trading part of the portfolio, which is really based on signals and signal generation that we can glean from, as I mentioned earlier, all of that rich data in the blockchain ecosystem. So we combine those two pieces of the portfolio, just like people combine stocks and bonds. You kind of have your return enhancers and your risk reducers. We do that same thing, but we do it with two different strategy buckets. We do the long-term value appreciation, which is kind of that return enhancer piece, and then the risk reducer part of the bucket, which is more that systematic piece. And we've done quite well, almost 900% return since inception. We have now almost a 6-year track record, or actually we do have a 6-year track record. It's been just a fantastic fund from my perspective, as with a significant portion of my own net worth invested in the fund, but also for many other investors that have really kind of enjoyed this ride without all of the volatility. We did have that one down year, but outside of that, I think our performance has been really quite stellar compared to all these other asset classes and major categories of investing.
Yeah, Eric, I know a lot of folks, where do I fit crypto into, a portfolio, and how does that fit into a larger portfolio? I think we want to walk through just 2 more slides real briefly here, how that kind of works. And one is, just on a net basis, we have outperformed basically, dramatically have outperformed historically a lot of other fund managers in more traditional asset classes.
And didn't just do it like in a given year, it's or, we just had a great year. And then this is like over and over and over, with the exception of that one big down year. So it's really, that's the most important piece of this, is like, how do I use that with the rest of my portfolio? We're not saying get out of stocks, get out of bonds. What we're saying is let's see how you could pair that up. So I think on the next slide.
Yeah, it's a great transition. And so, Eric, talk a little bit about this, what adding Blockforce to a standard 60-40 portfolio can do.
Yeah, so your typical 60-40 stocks and bonds, 60% stocks and 40% bonds portfolio generated a wonderful return for the average investor over the last several years. What we did was we said, what if you took that same exact portfolio, that's this column on the left here, this 60-40 portfolio, but instead you took 5% and you allocated it to our fund, and how would your returns have been over that same time frame? So just a 5% allocation to the fund, rebalanced on a consistent basis. You improved your overall returns by almost 87%. You're on your annualized basis, almost 5% per year. And, you compound that up, it's almost 100% more return that you would have otherwise earned. And you only did it with a 0.2% increase in risk. Risk is just the standard deviation. So it's just the ups and downs, how volatile those are. And in an up market, you kind of want standard deviation. You want that upside risk. You just don't want the downside risk. And that's what this next metric is, this short Sortino ratio, which is really capturing, for every dollar of return do I get, how many dollars of downside risk do I have to suffer through? And above 1 is a much better, for every dollar of risk do I take, or every 1% move of risk, how many percent return do I get? And in this case, it's a 1.6. Anything over 1 is great. So we're really proud of that. And then with the max drawdown, it doesn't even hardly impact your overall kind of worst period of performance. So again, we're not saying put all of your assets into a strategy here. what we're saying is take a little small percentage of your allocation and allocate it to this asset class so you can take advantage of the upside going forward.
So we'd love to talk to you more. Please contact us at invest@blockforcecapital.com. You can also reach out to Ervin Katz, our partner and head of investor relations, at Ervin@blockforcecapital.com. We'd love to set up some time to talk and answer any questions and give you more detail and context on Blockforce.
Thank you.